All right, today we're going to go way beyond the basics. We're on a mission to find the single most powerful way to use one of investing's most trusted tools, dollar cost averaging. We're going to dig into the data and see how we can seriously supercharge this thing. You know the feeling, right? We've all been there. You see the market flashing red and you think, okay, this is it. This is my moment. You wait, you watch, trying to nail that perfect bottom, and then whoosh, the rocket ship just takes off without you. It's just so frustrating. And trust me, you are not alone in feeling that way. The hard truth is, trying to perfectly time the market, it's a losing game for pretty much everyone. It's stressful, it's emotional, and it almost never plays out like you imagine it in your head. So this whole experience, this really common problem, it actually has a name, the market timing trap. But the good news? There is a very well-known and very effective way to get out of it. And that brings us to dollar cost averaging, or DCA. The concept here is just brilliantly simple. You invest a set amount of money on a regular schedule, let's say $100 every Friday, no matter what the market is doing. This is huge because it takes your emotions completely out of the picture. When prices are low, your $100 buys more of the asset. When prices are high, it just buys a little less. Over time, this automatically lowers your average cost. And getting started is incredibly easy. First, you pick what you want to invest in. Then, you decide on that fixed amount you're comfortable with. Third, you set the schedule, weekly, bi-weekly, whatever works. And then, and this is the absolute key, you put it on autopilot. You automate it. That way, you're not tempted to meddle or second-guess the plan. Okay, so DCA is a disciplined, really powerful approach. But that brings up a super important question. Where does this strategy actually shine? The asset you pick makes all the difference in the world. So let's start with stocks. Now, major studies from huge firms have shown that if you have a big pile of cash ready to go, just investing it all at once, what we call lump sum investing, actually beats DCA somewhere between 67 and 92% of the time. Why? Well, because over the long haul, markets tend to go up. But, and this is a massive but, DCA provides this incredible psychological shield. It protects you from the gut-wrenching fear of investing everything right before a huge crash, which helps you stay invested when things get scary. So what about something like Forex, the currency market? Well, long story short, it's not a great match. See, currencies tend to bounce around inside a range instead of having a strong upward trend. You combine that with the high leverage that's common in Forex, and your DCA strategy can get really risky really fast. And that brings us to our third contender, crypto. Now, this is where the entire game changes. Just to give you a sense of scale, Bitcoin has had a compound annual growth rate of over 100% in many of its cycles. I mean, that's just a totally different universe of growth, and it creates a very special environment for a strategy like DCA. So here's the thing, right? The very qualities that make crypto seem terrifying to some people, that insane volatility, those wild swings from bull to bear markets, that's exactly what makes it the perfect playground for dollar cost averaging. Those huge, scary price drops become massive opportunities to stack up more of the asset at a deep discount. It's why in crypto, DCA can actually beat lump sum investing, especially when you're investing through a bear market. Okay, so we've cracked it, right? DCA in crypto. Just set up your weekly buy and you're good to go. But what if I told you that standard DCA is really just level 1? Because we can take this already fantastic strategy and completely supercharge it. The data points to more advanced, more powerful ways to do this. Think about it. Instead of just buying the same amount no matter what if you were a bit smarter? What if you bought more when things were cheap and maybe eased off the gas when prices were going crazy? That's the idea behind strategies like value averaging or adaptive DCA. These methods can leave the standard approach way, way behind. And here's a quick look at how they stack up. You've got value averaging, which tries to keep your portfolio on a steady growth track. You have adaptive DCA, which uses market fear as a trigger to buy more, and dip-weighted DCA, which is a simpler version of that. But just look at that last column. That's what matters. We are talking about some serious data-backed improvements over the basic strategy. And if you're a visual person, this chart just says it all. If standard DCA is our starting point, our baseline, these enhanced strategies are a massive level up. We're not just talking about a couple of extra percentage points here. We are talking about potentially doubling the amount of the asset you can accumulate over the very same period. And hey, you don't have to take my word for it. The research here is it's incredibly compelling. This quote from the source material is wild. Backtests show a hybrid approach can accumulate 50 to, get this, 300% more coins than a simple fixed DCA. That is a life-changing difference. Which brings us to the final piece of the puzzle, the part we've been building towards, combining all the best ideas we've talked about into one ultimate evidence-based strategy. So, the data tells us the most powerful approach is a hybrid adaptive value averaging method. It sounds complicated, but it's not. It just means we take the discipline of DCA, the smart logic of value averaging, and the pure opportunism of buying the dip, and we roll them all into one unified game plan. So how do you actually do this? Well, it's a 5-step plan. 1, you set a target for how you want your portfolio to grow. 2, you have your regular automated weekly buy. That's your foundation. But here's the magic. 3, you attack the dips. When the market panics, say a 20% drop, or the fear and greed index hits extreme fear, you invest 2 to 5 times your normal amount. 4, and this is just as critical, you pull back when everyone else is euphoric. And 5, you apply this whole engine to high-quality assets. Let's make this really concrete. Imagine you started buying Bitcoin right at the top in 2021. With a standard DCA plan, you might have ended up with about 1 Bitcoin today. And hey, that's a fantastic result. But with this adaptive hybrid method, by going in hard during the 2022 crash, you could have accumulated more than double that amount. We're talking massively higher returns, just by being smarter about when you deploy your cash. So let's wrap this all up. What are the big takeaways here? First, discipline always wins over trying to be a market timing genius. Second, DCA was practically made for volatile assets like crypto. Third, standard DCA is good, but adaptive, intelligent strategies are just plain better. This hybrid method is the strongest, most evidence-based approach you can take. And remember, the whole point of this is to play the long game. We're thinking 5, 10 years, or even more. So we've gone from a simple, elegant idea all the way to a professional-grade, data-driven investment framework. Really, the only question left is the one right there on your screen. Now that you have this powerful strategy, how are you going to put it to work?
Please like and subscribe for more trading content, and then subscribe for more daily, weekly trading insights.